Good morning and welcome to Morning Markets. Today we're going to be focusing on Japan and why their wage growth data surprised markets. Yesterday we had wage growth data from Japan which surprised markets. There has been increased speculation over the last 18 months that the Bank of Japan will be able to move away from their unorthodox monetary policy of negative interest rates. Remember, typically you'd expect positive interest rates like we have here in the UK at 5.25%. Japan has negative interest rates at minus 0.1%. The speculation within the markets over the last 18 months is that given the stronger wage growth dynamics that have come through in a post-COVID world and the stronger inflationary environment, remember this time last year Japan had inflation at 4.4%, that the Bank of Japan could move away from negative interest rates towards positive. Really what they're looking out for is a stronger wage growth impulse, and that has started to come through last year. The data that was released yesterday was a surprise in that the wage growth was weaker than expected. Looking at the numbers, total cash earnings, that fell from a 1.5% in October year on year down to just 0.2%. So weaker than expected. And when you adjust these numbers for inflation, they're actually negative. So consumers' purchasing power is weaker. So looking at the numbers, we went from minus 2.3% in October to minus 3% in November. And that really means that there's a sense within markets that perhaps the Bank of Japan has missed their opportunity in this economic cycle to move from negative interest rates to positive. So how did the markets respond? Well, it was actually a positive response because interest rates aren't going up, or there's less probability of interest rates going up. So yesterday, Japan market was up 2%, and this morning it was up 1.8%. So good returns from Japan over the last couple of days. In terms of looking at what we'll be watching out for today, all eyes will be on the US inflation report. Over the last couple of months, we've seen markets respond very well in both equities and bonds to the fact that the market's getting more optimistic that the Federal Reserve, the US Central Bank, will start to cut interest rates more aggressively this year because inflation has been trending much lower, currently around 3%, and has been coming in below market expectations. Today, expectations that the headline inflation rate will go from 3.1%, marginal increase to 3.2%, but it's the core inflation that will be of great focus. So that's inflation deducting food prices and energy prices. That's expected to fall from 4% to 3.8%. If we get a reading below these numbers, then we'd expect positive returns from both equities and bonds. In terms of looking ahead to tomorrow's morning markets, we'll be changing the format slightly. It'll be more of a discussion and really reflecting on the key events this week and how the market has responded to those key events. That's everything from us today. Thank you for watching, and we'll see you tomorrow.